Let's talk about something that hits close to home: war and your wallet. It seems weird, right? A war far away messing with your mortgage rate? Well, it's because war completely rewrites the economic playbook. Let's dig in. Take World War I. The US funded most of it by borrowing. That set the stage. And this leads to something called financial repression. It's basically a hidden tax to pay for it. So you end up with this massive gap between the real market rate and the government's low rate. Then came World War II, which took this whole idea to a crazy new level. The Fed basically said, long-term borrowing costs will not go above 2.5%, period. So the Treasury got a blank check for cheap credit. But oh boy, there were consequences.
Basically, people holding bonds got hit by inflation, and their money helped pay for the recovery.
And here's the result. That massive war debt, it just melted away thanks to inflation. But this whole setup created huge tension, leading to a landmark agreement that changed everything. This was basically the birth of the modern, independent Fed we know today. Now you can see how different wars were paid for, and each method had a different result. The Vietnam War was a bit different. It was a lesson in what not to do. Okay, so that's the history. But what about today? The game has totally changed. When Russia invaded Ukraine, for example, geopolitical risk just shot through the roof.
See, now the economic shock hits us through things like energy prices and supply chains.
And central banks had to react, hitting the brakes with some of the fastest rate hikes ever. And get this, for central bankers now, geopolitical tension is an even bigger worry than inflation. So it all comes back to this one core problem. Governments need money for war, but central banks need to fight inflation. For investors, this history gives us a playbook for today's pretty chaotic markets. Which leaves us with the big question: can central banks stay independent in the next big crisis?